Right.
I hope you're having an amazing day. I'm here today with Rick, and obviously my name is Colin. Launchpad School, episode 6, 7. We're going to
7.
have a look at profitability estimation on launches, right? The key performance indicators. What do we want to for sure look at? What don't we want to look at? Of course, previously we have discussed the white paper, tokenomics, all these individual components. And if we combine these components, we can definitely get a nice projection on how projects could perform, right? So I'm going to share my screen. I have the Communitas Launchpad, Seedify Launchpad, DAOmaker Launchpad, and each of them have either active listings or completed listings, upcoming listings, right? So I want to have a look at each of these elements, perhaps compare some projects to see what went really well, take into consideration current market conditions, and what didn't do that well, right? So of course, Steppen is one of the biggest successes of this year, 149x on the all-time high. The raise was also quite high, almost 3 million. You have 2 million, 1 million. So you can definitely see DAOmaker has the bigger raises. Seedify usually stays below 200K. We have total raise 237. Oh, this one's 522, which was done quite recently. I'm talking full of shit, apparently. 475, 284. So between 200 and 500K, 380, 380, 380, 170, but this is the same project, right? So 500K. Yeah, so quite big raises on Seedify, interesting. And then Communitas is the smaller races, right? So this is 100K, 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 100, 200, 10,000. But this is an NFT race, 150,000, 100,000, 90,000. So the question is, most of these projects provide the same information, right? When you look at these projects, most of the launchpads, no, other way around, most of the launchpads for the projects provide the same information. So usually it's this information, right? The token change price, minimum, maximum allocation, and how the rounds would work. So one tricky feature here with Communitas is that you have a general swap rate, which is 0.5 cent here in USDC. And sometimes the rounds are different, right? So here there's a fee, 5%, and here there's a fee, 10%. So that's, I don't know if that's subtracted from the tokens you receive, but you have to take into consideration that fee, right? Because you're not getting the direct swap value. That on Seedify and on DAOmaker is not applicable. So let's pick Mazy, for example. Did an 18x. Might be interesting to pick some of these projects up and see what their current performance is, because obviously an all-time high doesn't really mean that much, right? It would have to stay consistent. So fully diluted value, 92 million right now. Oh, they have some ROI metrics. Current price, 9 cents. All right, so still from the public sale, 3.7x, which in the current market conditions is quite good, but it was only 10% TGE, 20% TGE for public. But they have some nice information here, but it's quite difficult to read. You know, what would be better is what I showed you before, which I didn't show you on the recording, coming soon to Track Digits, hopefully. And when I say coming soon, in the next 6 months. Lots of work.
Soon enough.
Anyway,
Soon enough.
Yeah, we have time. We have time.
Yeah, of course.
Oh, so Amazy was Seedify and DAOmaker. Oh, actually, it's the same project. I didn't even see that. All right, perfect. So on this level, the interesting components to analyze, right? We were looking for key performance indicators on how to see if a project is going to be successful. So Amazy did quite well, right? Let's look at what didn't do that well, right? Because I assume they would list all of their projects. So here you have a 2x, 18x, 4x, 150x, 12. And this is already some time back, right? So Steppen is already quite a long time ago, right? I don't know when this actually went live. I don't know if they have the dates there as well. Verstappen was definitely a couple of months back. Yeah, so the mainnet launch 2022 Q3, Genesis NFT beta launch. I don't know, the TGE is not on the roadmap, unfortunately. So no direct information, but that has been at least a couple of months, right? So the question ultimately is, how can this project achieve 149x, right? And still be up 18x from the
TG.
public sale that it did. And it's still being vested for quite a long time. You see 10% TGE. And then there was another project which only did a 2x, which was Wing Raiders. So a lot smaller race, ROI, so below IDO price. And still quite similar vesting. So obviously we're not going to skim through everything, but what could be one reason? Because what is important to note is that vesting usually plays a big role, right? If we take a project like Blocks with 100% TGE, 100% TGE in a bull market is a bad idea. So you can imagine in a bear market, it's basically suicide mission, right? The only real there could be one reason why a project would offer 100% TGE. And I actually talked with the tokenomics advisor, like a real tokenomics advisor. He has done like over 150 different projects, the tokenomics. And I just asked him, what could be the reason? Because I have my own hypotheses and I just wanted him to confirm it. And he confirmed it. There's one reason to have 100% public sale TGE. What could that be? Because if it's not there, then you know, red flag, right?
Mm-hmm.
And would basically be a reason not to invest in general. But what could it be? It's quite interesting.
Yeah. Like you said, it's just a suicide mission. I'm incredibly curious what he came up with for a reason. I mean, again, like Anthony says, where we did talk about it before, if they're super confident that there's going to be a lot of utility to the token to come in the future, but even then, doesn't seem like a good idea to do it regardless.
Well, if you have a lot of utility to come in the future, then there's no utility for the token right now.
Right.
And if 100% of the public sale, which is usually more than 100,000 tokens likely, right, is going to flood the market, then there's one thing that you would need to make sure that the dump doesn't happen.
Right. Yeah, that's what Anthony said. Like that, if there's already a lot of utility to the token.
Yes. And what doesn't count when we say utility?
Staking.
Yes.
Yeah, staking mostly.
Staking and one more, but it's basically the same thing as staking, but then on
farming.
Yeah, then on the LP farm, liquidity farming and staking, that doesn't count, because what happens is that dilute the supply, right? So because you have to give yield over those assets, that's not product-led utility. And anybody that says that that's their utility, they overestimate their capabilities as a project. Day one utility. So for example, on the Digis ecosystem, if we run it without token and we ever decide to implement the token, I wouldn't do 100% TGE, but we could, because as soon as the ecosystem switches from off-chain to on-chain Digits coins, there is the same utility. We have all the data behind it, how much consumption there is, supply, demand. So it would make sense in that case to actually do 100% TGE. So as soon as you see 100% TGE, big red flag, right? Why? Because it makes no sense. Usually it's because of poor tokenomics design, right? If you want to go fast with the vesting, right, because you supposedly have some utility, at least do 4 times 25. 1 times 50, 2 times 25, because those 3 months for a business means nothing. Those 90 days go by so fast. But at least if it's a problem, then you have to deal with half of the problem size or
Right.
1/4 of the problem size. So it's just a bite-sized chunk,
So
and it has to do with
i-
risk.
in your opinion, a 100% TGE is per definition always bad. There's
Always bad.
no always bad, even if there
Yes.
is a lot of utility to the token right off the bat.
Well, that's the thing. What would the utility be? So no staking and no LP farms included, right? Those don't count. Let's say, that's what I just said. On the Digits ecosystem, we have 4 products that would consume the token straight away. Subscriptions, pools. In that case, we could do 100% TG. It doesn't matter because 100,000 tokens enter the market and immediately people can use them. So the thing that you don't want is for those tokens to be dumped and sold against the liquidity pool, right? Because then the company pushes liquidity in the liquidity pool because it's 2 assets, and everybody sells against the liquidity pool and the price goes down, basically. Ultimately, that makes no sense because they're basically raising funds, putting the funds in liquidity, and the investors sell back at a loss into the liquidity pool. And then we still keep the money, but a little bit less, but the investors lose double, right?
Yeah.
It's like the equation. So in the case that we would have products that would consume, or any project would have a product that consumes their governance token, in that case, they're not being sold off, they're being traded. User gets product, company gets their own token back, which is again revenue, right? As it always is, but the price doesn't go down. If the utility is there, the investors and other users have higher demand. So in that case, price would go up, right? But it all depends. You don't want the price to skyrocket, right? I know investors only look from their own perspective, and that's one of the biggest weaknesses of investors. Because let's say you would charge 300 digits coins a month for a subscription, right? Let's say 30 bucks. If the price goes ×3, that subscription is now 90 bucks. Or every time you have to change the digits coin value on your website, you're not going to do that, right?
Right.
So for a company, let's say a company like Unix, for example, maybe they want to raise equity. If their token shoots up 10x, that means their fully diluted value also shoots up 10x. So let's say you want to buy our company, we have a conversation with you, you want to give us $10 million, and the next day you need to give us 100 million. The deal's off because you don't have that kind of money, very likely, right? Of course, it's not that easy, right? There's a lot of things around it, but price
Simplify.
volatility, like the faster it goes up, the faster it can go down. And it's always better to have a linear upward trend than like pumps.
Yeah, of course.
So no 100% TGE. That's one of the big things, right? One of the other big things I look at nowadays, specifically when the market is a little bit bearish, is vesting terms, right? So you have to take into consideration basically the lockup. 5% TGE, 3-month lockup, so that's the cliff, and 24 months vesting. So you're a quarter in. So this is the 1 month, a quarter, and then 2 years. So it's almost 2.5 years, right? It's 2 years, 4 months.
Yeah.
When we look at Steppen, they worded it different, but it's 1 month, and this is about 4 months. And then there is 90% left, so that's 10, 8, 18 months. It's a year and a half. This is 4 months, so almost 2 years, just under 2 years, right? Is the vesting. That's long, right? Almost as long as this one. So the question is, relative for your investment, how long would you want to wait? You know, if I invest into a project I looked at recently, Snickerdoodle, right, which is a huge ecosystem, quite big, has a funny name, right? Gunzilla, which is a huge game studio. There's over 100 people working there. What was the Gala game competitor that we, Myria, You know, those are big, big companies, you know. If I have to invest and wait 2 years for my tokens or get like 5% monthly for 2 years, maybe 3 years, that's fine. You know, I have some higher risk tolerance because they have 100 employees. If you have 100 employees in your race, you know, I think they raised so far like 200 million, right? Because they did 100 million on token and now they raised like 100 million on equity. So they're raising funds beyond the scope of a retail investor, which means that there's parties with bigger bags that put the trust with the money in them. So if they have the same vesting, then it must be justifiable that way, right? But let's say you have a project like, I don't know, any of the ones we saw before, like these play to earn games, which their market cap on TG. So I think when Godzilla will do its TG, the market cap will be 20 million, something like this, very high because they raised so much money, right? So the
Right.
token prof value is already high. So even if they only do 1% TGE, it's already 2 million, which is like, that's the inconvenient part of raising a lot of money. You have a high valuation. But
Right.
that's a good thing for the company. So such a project like Steppen, you know, right now valued at 93 million, it's almost a 20x, right? So when they launched, it was 4.5 million TGE ish, 5 million, let's say 5 million. It's quite high, you know, 5 million on TGE. So in that case, what I'm getting to is, are these B type projects, not the enterprise scale projects, right? Are they worthy of extremely long vesting? Because long vesting is usually tied to a high valuation.
Mm-hmm.
So that's something to consider from an investor point of view. Of course, that's not like, it's something I look at. It's not something I would say is super generic for everybody. But in my opinion, I think when I look at it, I would say long vesting is only justifiable with your feeling of the project. If it can perform well long term, and take into consideration, 6 months in crypto is 2 years in Web2, right?
Mm-hmm.
Because the industry moves a lot faster. There's a lot more development. Star Atlas or these kind of games cited as heroes that have a roadmap of 5 years. In 5 years, crypto gaming will look so different than it is right now. So how
Exactly. Yeah.
likely are these companies able to survive and or compete without major adjustments? I heard today from Herman that DeFi Kingdoms, which was built on Harmony, Harmony's biggest project, after the hack, they signed Clayton blockchain today. So they're going to migrate. Harmony loses its biggest asset, right? But that's a huge switch for a company in terms of tech to migrate blockchain, right? And all the headaches, that's going to delay their plans for at least 6 months, right? But they must have enterprise style big plans because otherwise you wouldn't make that change, or serious security concerns. But 5 years roadmap, there will be 1 or 2, maybe even 3 of these major adjustments, which means their roadmap is now 7.5 years, right? Which is
14
21
years.
years,
21 over.
14 to 21 years Web 2. So taking these things into consideration, your investing that is tied to that, let's say it goes extremely well. It's also a possibility. Let's say it goes extremely well and that, you know, that 5% monthly is now worth, you know, 100x. Then it means that in that year that vesting happens, let's say in year 2, there needs to be a lot of utility because these tokens will be dumped at 100x. Every investor will just dump these tokens, right? Which is an interesting thing to think about. So the next part, apart from the TGE amount, is the vesting, right? It has to do with risk tolerance. How long are you willing to wait for the project that you desire, right? And I can pick up some different projects because now we just looked at both quite long vestings, but there should be some, specifically when you look at lower races, is likely not, the lower races usually don't have that long. Oh, same thing, 24 months, okay, it's quite long.
Yeah, I
Or
usually
maybe
see
it's
long
down maker
vestings.
specific. Sorry?
Yeah, yeah. I only see longer ones mostly, and especially on DAO Maker, but usually the smaller launchpads tend to have smaller projects vestings as well.
Let's look at
Maybe
this one, Dragon
Communitas.
SB. I have no idea what Dragon SB actually is. It's a game. 60-day,
MMORPG.
4.5%. Oh, but it's a seed.
It's
Oh,
built on
here.
Terra.
20. Oh, okay, never mind. 20% TGE, 60-day cliff, then 20% quarterly. Okay. Also long vesting. So all the DAO Maker projects have pretty long vesting. What's interesting to note is they all have quite good returns and they have quite long vesting, right? They don't have any project that went minus. They don't have this one listed, but maybe it doesn't have done TGE yet. The rates were really small. Even their smallest one at the all-time high did like a 2x. It's minus right now, right? But it wasn't garbage from the start. Okay, so I don't think Seedify lists their vesting. It's really annoying. No. It doesn't. The Communities does right here. 10% TGE, 3 months vesting with monthly unlock. So that's 90, 30% per month. 10% TGE and then 30% monthly, which is quite quick, right? Fitten. 25% TGE, 1 month cliff, linear vested for 4 months, which is 75% divided by 4, also quite quick. So in 6 months, everything is being vested. But these are all public rounds, right? So do note that they're all public rounds, and these are all like the move to earn 25% TGE, 6 months daily linear vesting. All right. The question, Rick, if you could choose between, let's say the vesting is 6 months, you could choose quarterly vesting, monthly vesting, weekly vesting, daily vesting. What would you prefer?
Yeah, I suppose monthly. It also depends a little bit on the roadmap. I mean, if you get it quarterly, you get your tokens. It will take ages for you to get it. So I wouldn't go for quarterly. Daily, I mean, there's a lot of volatility in the price over a day. So, you know, it could shoot up at any given moment. I feel like monthly is more, goes better with the roadmap and certain points that the project is working towards. So it just works better monthly, in my opinion.
What does the price have to do with anything?
Price. Well, that's what you're going to be getting, right? If the price is high, then you're going to be vesting your tokens at a higher price.
Do you get, what is it that you get? Do you get the price for the token or do you just get the tokens?
You get the tokens, yeah.
Okay, so those tokens, whatever the value is, does it matter?
I suppose it does. I mean, the more the value, the more you just earned. But I know what you're getting at. You mean like you just want the tokens.
Do you earn the money when you claim the tokens or do you earn the money when you sell the tokens?
When you sell the tokens, yes, that's right.
Okay, so when you claim the vesting, you haven't earned shit. Potentially unrealized gains, right? Unrealized gains. It's a very important, that's why I'm getting at it. It's a very important investor acronym. Unrealized losses and unrealized gains. You don't lose until you sell, right? That's also on that side of the equation. It's not 100% true. And that's why we call it unrealized, because you realize it once you sell it, then the asset is gone and you can't turn it back. Otherwise, you just have to wait and the price might differ. So once you claim the tokens, you just get the tokens. Whatever that price is at that point, it's irrelevant unless the goal is claim and sell immediately, right? But that doesn't have to be the case. So again, I give you the choice. Quarterly, monthly, weekly, daily. Monthly is not the right answer.
Well, then it would be daily.
Daily? Why?
Get your tokens as quick as possible.
Yes. So quicker is always better. But now I get my tokens as quick as possible, but everybody does. How does that work?
Yeah.
There's
you'll
always
see
a
that.
pros and cons equation, right?
Yeah, exactly. Well, just how I went in with the mindset of I'll get my tokens and I sell it right away. I suppose other people will have the same mindset and just dump. Exactly. They'll just dump the tokens as soon as they get it every single day.
So the thing is, with daily vestings, nobody's going to claim every day.
Okay.
It's too much effort. So what happens is, because there's not one date, the claims, maybe people will claim once a week that are really desperate. People like me never claim. Where on monthly, I might claim, but with FIN, it has linear daily vesting. I haven't claimed shit, right? Because just can't be bothered. There's not a moment in time where I need to claim to ensure I'll just let it stack up, right? So with daily, usually the serious investors, they don't claim, right? They will claim whenever they run into your project again on coincidence or they check something. But what happens is you spread the risk. So this is the chart, vesting, sell off. And with daily, it's like this, because people can claim at any time and sell at any time. So you spread it. So the market maker who stabilizes the market has less work to catch the dump on a day. So it's pros and cons. But for the investor, the pro is that you can claim at any time, right? Would you claim your tokens every day? If you have nothing better to do?
I mean, if you have nothing better to do, might as well.
In which case, when would you not claim your tokens every day?
In which case would I not claim my tokens every day?
Yep. Even if you have time.
That's a good one. I mean, there's not really a reason not just to get your tokens. I mean, you can then do whatever you want with it.
Would I ask you if there wouldn't be a reason?
I don't know. Maybe it's a trick question. Maybe it's a trick question. Okay, no, I wouldn't know that. No.
Think about it.
All right, then we're going to think about it. So we have the option to grab the tokens right now, but we don't.
Yeah. So let's say daily linear vested for 300 days. You invested $300. So every day you can claim $1 invested worth of tokens. Let's say it has done a 5x. You can now claim $5 a day. In which case would we not claim this amount?
I mean, why not? I wouldn't know. I would grab that $5 every day.
I don't think so.
I see here the gas too high. Is that it?
Yes. If it's on the Ethereum blockchain, the gas is likely to be $3, $5, $7 in the bear market. In the bull, it will be $40, $50 per transaction. So you're not going to claim every day if it's on the Ethereum blockchain.
Right.
If it's on
Okay.
Bitcoin blockchain or any blockchain that has congestion.
Right.
So yeah, perfect. Some support
on
from
that
the chat.
bicycle.
Yeah, that's a very important one because most of the daily linear therefore happens on Polygon, on AVAX, blockchains with lower gas fees. You will never see an Ethereum vested project with daily vesting because it's useless, right? Makes no sense. It will always be monthly in that case. So you have a choice, but you might not always have that choice. But it's good to understand that it will likely not happen that Ethereum has daily vesting, but why not, right? That's basically the side.
Gas fees. Gotcha.
Yes. All right. So that's something to take into consideration as well. The blockchain that it's running on relative to the type of vesting that takes place, right? Now we go to some more basic terms because we went a little bit sideways. So we have basically discussed ultimately coming back to the question, how can you scope the profitability of a launch? It's only to count the red flags. So if you count the red flags, the likelihood of it not happening. That's basically the structure which we follow, which is called method of exclusivity, right? We exclude everything that doesn't work. So then what you're left over is what potentially should work. Yes. And then if it doesn't work, then we blame market conditions or blame the team, right? Something like this. Right. Okay, so one thing that is important is documentation, right? So a light paper or a white paper, I would say for me that is required. It shows that the project is serious and has put their time and effort into creating that documentation. It might not be always of the best quality. In our last call, we reviewed several white papers. They were all very different, but they give you more information than the website would. And even if it doesn't, it's all collected in one place, which is super convenient, right? So you don't have to
Mhm.
look around. What's the difference between a white paper and a light paper? It's already 2 weeks ago since I asked you that question.
I was about to say, I remember the question actually. Yeah, so a white paper is more in detail and is created later. So you first have the light paper, which is more of a quick pitch, and then you have the white paper coming after that.
What is a pitch deck?
Pitch deck. It's to pitch the project. Is it not?
So the trick is not to use and repeat the words.
Okay, so should I explain what a pitch is then? It's
No, not
like
a pitch. I don't need to know the pitch. I want to know the purpose of a pitch deck. Why would the project
yeah,
make one, and what is it used for?
yeah. If I say to pitch the project, you're probably gonna
To
disclude
whom?
that. Good one. I don't think to casual investors for the rounds, because that is what the white paper is for. So I suppose the seed investors or the very early investors.
Yes, sir. So
Yeah.
you use a pitch deck when you don't have a white paper, or you use a pitch deck to give them a very brief overview of what your project is about. Usually 10 to 28 slides. It's always a presentation, and it's usually full of images, not text, because you're talking and you're just showing them on it's not an elevator pitch, but you have 30 minutes with a VC. You show the pitch deck and you just run through it while you talk. You give them the visuals so they understand, and thereafter you send them a white paper if you have one. But usually it's so early stage you don't have one, because you have no product, right? The 99% of projects are raising funds and they have no product yet. So the pitch deck is definitely interesting, but not required, I would say, because if you have the light paper, white paper at that point, right, and we're now talking about public sales, then that whole pitch deck is a little bit of repetitive information, usually too little. It usually covers the market research, basic idea of the product, and then tokenomics. No vesting, no prices, usually just the basic allocation percentages of the tokenomics.
Right.
All right, now we go to tokenomics, right? Let's have a look at the tokenomics. My favorite part. Okay, so here they have barely any information, but let's take this one, because Downmaker usually has quite good information on tokens and shit. Where is it? They have like a tab, right? I think you have to click somewhere to get the, oh, here, metrics. There we go. On-chain token, data provided by project. That's strange. That's not the same.
Not at all.
Interesting.
0% marketing and partnerships. No, the left one is definitely not correct.
2% project data, on-chain token distribution. Perhaps this is how it's distributed right now on everything that's available. And then this is everything that according to the tokenomics. So they're still, so they had to put more liquidity, as you can see, 8% more, based on what's now in circulation. I assume that's the case. It's a little confusing indeed. And then you have all the information here. What was it that we were going to look at? I forgot.
The tokenomics.
Tokenomics, right.
Yeah.
Okay, I have questions. These are the tokenomics, right? These tokenomics are so fucked. Let's take a different project because the team is not even on there.
Yeah, I was about to say. Well, it is on the left one, but it's not in there on the right one anymore.
It makes sense that this project didn't do well.
Well, that's step one. Look at the tokenomics. Let's see.
All right, let's see. Metrics.
Yeah, this one looks better.
Okay. 1, 2, 3, 4, 11. What does this mean? Influencer allocation. Because ultimately, once we review the tokenomics, we need to understand what everything means.
That's right.
And there's no legenda or anything explaining it, what it means or how it works.
No. Just says they're giving an 8% allocation to influencers.
Yeah. So is it just a gift, or how does that work?
I don't know. I've seen it before that they have influencers basically promote the project for X amount of tokens, but this is not very logical to me, what exactly I mean. I assume that on their own website they would have more information on this, and if not, then it would just be very sloppy.
They don't. And it's not sloppy. It's just need to use your brain a little. So
Influencer allocation.
yes. Usually it would just say strategic round. Same thing.
Yeah, but strategic is also other people apart from influencers, is it not?
Yeah, could be, but that's why it's called strategic. It has a specific purpose. They get something in return for this, right? That's why it's called strategic round. So usually all the KOLs, key opinion leaders, aka influencers, they're in the strategic round. The question really is, because here it says influencer allocation. Do they need to buy the allocation, or do they get the allocation for free?
No, they get the allocation. It's in the tokenomics. They get it.
It
They
is
have
in
to
the
buy it.
tokenomics, but public sale is also in the tokenomics, but
Yeah,
they don't get it for
sorry,
free.
that says, yeah, so they get it for discounted price.
Do they? It depends on which round they are.
The influencer allocation is the round after the seed round, so that's still quite cheap compared to private.
No. I said influencers are usually in the strategic round, and the strategic round is after the seed round. But this just says influencer allocation. Specifically, they didn't call it strategic round. Why not? Because maybe it comes after the public sale. Who knows? So it's based on percentages, so you can't see it's just highest percentages at the top. But what we could do, scroll down right here, and yes, the influencer allocation is basically a strategic round because it's the cheapest one and has longer vesting. You're lucky on this one, but it doesn't have necessarily to be true. So in this case, it would be best if they called it strategic round, private sale 1, private sale 2, public. And then there's a very minuscule price difference here. That's very strange.
And look at that, they also get a 10% TG, and the private sale gets a 5%.
Yeah, it's both private sale. There's 2 different private sale rounds, but it's cheaper with shorter vesting.
That way influencers get a 10% TG.
Yeah, but that makes sense because this is also a 10% TG. So it's the same as private 1, and usually these 2 rounds are the same. But which is strange is that this one is more expensive and the vesting is longer. But it must be part of the deal. Nobody cares unless you're in this round and then you got fucked.
Right.
Basically how it goes. But it's important to go through this and to basically understand what it is. Okay, farming and rewards, it's basically farming and staking. Treasury is the company treasury. Team is team. Marketing and partnership funds, it's basically all the fucking giveaways and all the garbage around it, banner ads, blah, blah, blah. Strategic round, private round, liquidity is the DEX and centralized exchange liquidity. So a little bit on the low end even. Public sale, private sale, and then advisors, pretty clear, right? This side, they used the same information. So all understandable. Anything that doesn't make sense. So the reason we would look at the tokenomics, it's one of obviously the biggest parts when reviewing likelihood of profitability. It is coming down to something like this. If we go to, I don't know which round this is. I don't know if it says anywhere which round it is, which they host, but it's not really
private. It's the private.
Where does it say? I have
up left.
Private show. I don't know how you pronounce that. But then it's interesting if it's private 1 or private 2, because let's say it would be private 2, then it's extremely important to read these tokenomics based on what it is you're actually getting, right? Because we can all agree that the people taking the higher risk should get more tokens faster, which is true. But for this, in this case, it's not true, which is a little weird. Maybe this is a mistake. I'm not sure, but it looks really, really weird. Like maybe this is like one party that bought all the tokens. I don't know, but it's definitely a
Yeah.
strange happening. And therefore, you look at this. What happens if there's no liquidity on the tokenomics?
Oh. Well, then the price is going to be very volatile and easily manipulated by people selling the tokens, people buying the tokens, big spikes on the charts. It's going
Yes.
to make your investment a lot more tricky and risky.
Yes. So liquidity is quite important.
Of
When
course,
we
yeah.
calculate the market cap, does that include liquidity or not?
I believe it does.
So
It includes everything.
when I would look at Amazy on the launch and they say 1 million market cap TGE, does that include or exclude liquidity?
I think it includes it. I'm not sure actually.
Yeah, let's do a vote. Rick says includes liquidity. What do the people from the chat say today? Include, so this is TGE market cap. Market cap on TGE. Does it include or does it not include liquidity? I forgot the word, liquidity.
Well, usually there's an investing 100% TG release on the liquidity.
Yes, but that's not the question. The question is if it's counted by the project into the market cap or not. It's kind of an easy equation. So the answer is no. Let me explain you why not. So let's say we have a 500K market cap TGE. Now I'm going to provide 500K in liquidity because basically if I put the liquidity pool there, everybody can sell, the price will go down, but the liquidity pool will never go to zero. It's likely that the price will go down 10 times before the liquidity pool reaches 200K. So people can sell back against liquidity. But if I would add it up, then the TGE amount doubles, which is not favorable for investors, right? So the perceived one, usually the more serious projects like FN, they, for example, said it's 350K excluding liquidity. But any project that lists market cap on TGE always excludes liquidity because, well, that's a good question. Why would you exclude liquidity?
I'm not sure. Maybe it's because it's not really used. It's just sitting there.
Yes, and?
There's no end. No end for me. Because it doesn't do anything. It sits there and
It's not in the circulating supply. That's the keyword, right?
Right, you were looking for
It's
the
on the
circulating.
market, but it's not on the market because liquidity is locked. They cannot withdraw the
Exactly.
liquidity, right? So in that case, it doesn't impact supply and demand.
Right. Yeah.
So in that case, it is included in coin market cap, in the market cap, right? Because it is part of the
Important.
market cap. It's giving the
Yeah.
valuation of the project, right? But for an investor TGE, what is important is what is the amount of tradable volume, and liquidity is not tradable volume. You can only sell against liquidity and it has direct price impact. So ultimately, it makes sense that they exclude it because it's not, when you would say 200K TGE market cap, what does that then mean?
There's 200,000 in circulating supply at TG.
Yeah, $200,000.
Yeah. No. Yeah. Yeah.
Yeah, you have to define the metric, right? So tokens,
Right.
dollars,
Yeah. Okay. Yeah.
cows, ponies.
$200,000
Yeah.
worth of circulating
Yeah.
supply. Yes.
Okay, so how does that work?
What do you
Because
mean, how does that work?
liquidity is what the project pushes onto the market. But
Mhm.
how do the $200,000 enter the market?
Usually they also have their own vesting schedules, do they not? All of the tokens, they have their own vesting schedules, whether it is team or liquidity, private seed, etc. So that will
Yes.
determine when and how it will be released into the market.
Okay, so when it's 200K TGE, how does that work?
You mean the 200K is being released directly at TGE 100%?
I don't know if it's 100%. It depends on the tokenomics.
Mm-hmm.
So I'm asking how the 200K, which is the market cap on TGE, excluding liquidity, how does that work? Where do these tokens come from?
Yeah, they're there, they're created. That's in the smart contract, that's in the tokenomics.
Yes, that's all correct. But how does that work? They just like miraculously appear on the exchange, or?
Yeah, no, it appears on the exchange through the TG.
Yeah, okay. So let's say I deploy the smart contract, which means token generation event has occurred, and now all the tokens are on the exchange.
Depending on the vesting schedule.
Okay, so let's say those tokens are being vested, otherwise they couldn't enter the
Yes,
market. So that's step one. They
right.
come from whatever fucking round they come from. But
Yes.
200,000 tokens enter the market, value
Yeah.
$1, right?
Mhm.
Okay, so how do they enter the market then? How do they get onto the exchange and or not on the exchange into wallets?
Good question.
Yeah, simple question, I thought, but
apparently not.
maybe it's quite complex.
Well, yeah. Yeah, maybe if you
So
say it, I'm
it's not
like,
the
oh, of course.
project. It's not the smart contract.
Mm-hmm.
Then who's playing with these fucking tokens? Market maker, guys. It's the fucking investors that claim their fucking tokens, obviously. Market maker, that's
Right.
way too difficult. No. So the liquidity is provided by the project. They deploy the smart contract. At the moment the TGE happens, the investors can claim their vesting from the rounds, whatever fucking rounds they're in, they can claim the tokens. That's how they get into their wallet, and that's how they could end up on an exchange. So the market
Right.
cap is the value of the tokens being released from the vesting contract that it's claimed by investors and or any round on the tokenomics, doesn't matter. But that's the value coming out of the vesting that is being claimed. Very important. And then the user decides if they want to sell it or not. If they sell, market cap goes down because price goes down. If they buy or hold, then it stays the same or increases. Make sense?
Yes.
Very important because a lot of people don't know how these market caps get populated.
Mm-hmm.
What is an indicator of a high market cap? What does that mean? If they start off TGE with, let's say, 50 million market cap.
Mm-hmm. And the question is, what is an indicator that what is going to happen with a project that has such a high market cap?
Yes. Is it better than a small market cap? How is it different? What are the assumptions? What are the facts, potential facts that we could dial in?
Right. It means that there's already more money raised. Overall, less possible potential because there's already a higher market cap.
See my
I
face?
feel like you disagree with me. How about we put that out into the open?
So the keyword is potential. So whenever, and that's like business in general, right? A little business tip. When we compare two things, the keyword is relative. When we talk about things that could happen, we talk potentially. Because if you say potential, it's not true or untrue. It's just you think it might happen. And when you leave the fakeness around it, it's not facts. If you say otherwise a statement, you're presenting it as facts. So it's always good to just tie in potential everywhere, make it super fake, so you have no liability whatsoever. So you said, with a high market cap, the project could potentially have raised a lot of money, because that's not always the case. If their TGE percentage is very low, then the market cap is very low, and they still raised a lot of money. Example, They raise $500 million, but the TGE amount is 0.1%. So what happens is it's a 500K TG market cap, still very
Right.
low for a super high raise because they just adjusted the tokenomics, the vesting.
Mhm.
But likely they would do 10% TGE and then the market cap is 50 million.
Right.
Again, likely, right? Diffuse the facts. Okay, back to you with your hypotheses.
Hypotheses, right. Well, lower market cap, there's more room for growth. That is usually why they bring it up as a USP, right? You see the Bluezilla Launchpads
Yes,
with the very low
true,
market cap, right?
true.
We can grow. We're super, the market cap is very low. So I feel like that is the
Let's look
biggest.
at it from the other side. So if that market cap is low, it has a lot of room for growth. Then on a
Mhm.
big market cap, you have little room for growth. Is that right?
Theoretically, I suppose, yeah.
I would like to know why. Because it's true.
Yeah. Yeah, I couldn't give you a very I don't really know why that is. So no.
That is the interesting part, right?
That is the interesting part.
The
So
why is always the coolest
alpha
part.
information right here.
Alpha information.
Not from me.
It's okay. So let's assume we have 50 million market cap.
Mhm.
Even if the token price is $1, right? That's a lot of tokens.
Mhm.
So people put in a lot of money, but we already knew that because the total valuation is really high, right? How likely is it that if there's a lot of money to be raised, there's a lot of different investors? Likely or
Say again.
unlikely? How likely is it if you raised a lot of money that there's also a lot of different individual investors, different parties involved?
So how likely is it that if it has raised a lot of money, that there's a lot of different investors?
Yes.
Yeah, that depends. I mean, it could just be 3 very big investors. It doesn't necessarily mean that it's 5,000 very small investors.
Have you ever seen a public round with 3 investors?
No. Oh, you mean a public round? Yeah, a public round obviously
Or
has a
any of
lot
the
of smaller
rounds,
investors.
but a public
Yeah,
round usually have thousands of investors.
yeah, of course. Well, I mean, hundreds sometimes, but yeah, mostly a lot of investors. Yeah,
So unlikely or likely?
likely.
Likely, right? When you have a lot of individual holders, you have a lot of individual decision makers.
Mhm.
And what happens is something that we call the law of big numbers. When data is popularized on a big scale, stabilization occurs, right? If I flip a coin 10 times, you cannot count the odds because you might have 4 times head, 6 times tails, 5 times head, 5 times tails, 1 time head, 9 times tails. The periodization hasn't occurred. But if I flip it 100,000 times, I will get 499,998 times head and 502 times tails, 1,000. Because that is of how many flips the standardization occurs, right? So my background is advertising, which is basically only data analysis, right? It's just data, it just spits out. So you have a screen and you have different colors on the ads. We run the advertisement so many times that I can just tell you which colors, what the user is going to do. And that's called audience behavior patterns, right? What is the user going to do? Because we've done it so many times, hundreds and thousands of people clicking on their screen, we can forecast what the user is going to do next based on the colors, right? The same thing happens with large amounts of data. So if there's 500,000 holders, right, relative to 500 holders, on 500 holders, 1% dumps, that's 5 people, right? If on 500,000 people, 1% dumps, that's 5,000 people. Numeric value is a lot higher while the percentage is the same, right? However, those 5 on 500 will have a higher price impact than those 5,000 against 500,000, because that's how the market works. When there's more people involved, 500,000 people, there's also a lot more people in the liquidity pool, which means that the price fluctuations doesn't appear that heavy.
Right.
And that's one out of 20 different reasons why price impact is less significant on a higher holder count. That's why one of the key USPs for a token is different amount of holders. Because usually, let's say the value is 500K or 50 million, we said, right? With 500K people, that's 10K per person. If you would only
Right.
have 500 people, then it's 100K per person.
Yeah. Yeah.
And then if somebody drops, the price difference is way more significant because they hold more tokens. Number two, another reason, and there's a whole list. I cannot sum them up all right now, but it's super interesting because you would assume more money, more problems, which is true for the business, but for the actual token, it creates standardization. And that's why, for example, DAO Maker as a token has lost less valuation during the bear market than any of the other launchpads. Why do the layer one blockchains suffer less than all the tokens being built on the layer ones? Because it's a sum of its parts. The layer one value is built out of the ecosystem value that's behind it. If the ecosystems go down 90%, then this can never go down more than 90% because that would push down this value again, right?
Mm-hmm.
And basically the same thing with the more token holders, because this one has all these products, they all have 100K token holders, then this one has 10 million token holders, right? Because it funnels all the way through. That's like a number 3 reason, ecosystem, traffic proportion. But there's all kinds of different difficult reasonings that you could take into consideration where you would be like, is a project worth investing in, right? If the average allocation is $5,000 on a Launchpad. Yes, we all want high allocation until you get high allocation. So if you look at any pad right now, offering $3,000, $4,000, $5,000 worth of allocation because they cannot fill the pools, but nobody wants it. Because it shows that they're overexposing their investors to risk just to fill the pool. Because if nobody wants this allocation, it must mean it's shit.
Right.
In
Yeah.
a public round, right?
Yeah.
Because
Yeah,
the
exactly.
average allocation in a public round in a bull market is $5 to $15.
Right.
If they give you $5,000 right now, something is wrong.
Yeah, absolutely. Yeah, it's way too risky then as well.
Could be. Yeah. Likely. Right. Very
Hypothetically.
likely.
Right.
And ultimately, those are all the fake methodology words just to keep it all in the middle. You know, it's all circumstantial. That's the right word.
Mhm.
Circumstantial.
Yeah, of
Depends what we look at, how it works. But these market caps, you know, these vestings. So vesting is usually what people are quite aware of, right? Longer vesting, you know, it's risk reward ratio. But TGE market caps are quite a big indicator that people usually oversee. Lower market cap is not always the best thing. In which case, so likely if we would have anything under, you know, 100K market cap, it will pump, right? Very significantly. In which case, would that not have any benefit to you?
If the market cap is very high, low.
What? I
100K.
said, yes, I said the market cap on the project is 100K or less. It's very
Yes.
likely to pump. Ooh, the dogs, oh, they're gonna fuck you up. They're back?
They're gonna save me from
Yeah.
these difficult questions.
Is the last one, I promise. So the market cap is low, right? Less than 100K. Why would that not be in your benefit if the token is going to pump? Which is extremely likely with such a low market cap.
Yeah. Maybe if there's very little investors. Then there will still be a lot of risk, as you know, if the market cap is very low, but you also don't have that many investors, then there's still
Okay,
a lot of room for risk.
let's say they raised 10 million. Yes, they
Right.
raised quite a money. There's a lot of investors. The TGE market cap is 10K. 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 It will pump like crazy. But it's not
likely.
in your benefit. Why not?
I don't know.
Well, you know.
Depends on the vesting. I mean,
What was that?
maybe it depends on the vesting. I'm not sure why it would be a bad thing if you have such a low market cap with a lot of investors. Like you said, it's set for a big pump. So
Okay, so
don't
let's say
quote.
it does a 50x,
Let's say.
right? Once it has done a 50x, how likely is it to do another 50x?
Low. Very low.
Very low. How likely is it to do another 10x?
Higher,
But still extremely low.
but still very low.
Once it has done a 50x, is likely to go like this
Yeah.
after done a 50x. Okay, so the question really is, you said depends on the vesting. What does that mean?
Well, if you have again, with this current scenario, we expect a very big surge and then a drop off. But if your vesting is very long, then the big surge doesn't really matter that much, as you know, you're going to get your tokens after that anyways.
Right. Massimiliano is saying each one gets $1. 10,000 investors, 10,000 market cap on TGE. So either everybody gets $1. So if you go times 50, you have $50. Or it's extremely likely, according to the vesting, you guys don't get jack shit. There's just one group that has the 10% TGE that gets 10,000 and your vesting is 0% TGE. So what happens is the token pumps 50 and then has to come down over time. And that is when your tokens start to be released. So you
Right.
miss the pump.
Exactly.
So in that
right.
case, a low TGE amount is not that useful. In general terms, usually we only see this with meme coins in a bull run. Usually the TGE's amount starts at about 250, 280, because they don't want these tokens to pump too hard, right? If they pump too hard, there's also problems, people dumping, buying and selling. It's a good thing and not a good thing at the same time. So all things to be taken into consideration.
That is if you are not in the digits club.
What is he
You're
referring to?
if you're participating in such a bad launch, I assume.
Right. That's why we make these videos, to educate everybody.
Exactly.
I hope you learned something today, Rick.
Of course,
in terms of
every lesson.
information. I'm tired, so we're going to wrap this up and we'll be back next week. At least this was probably part one. Next week, we should do a little recap and then continue on how to spot high potential projects. Thank you, everybody, for participating. Rick, thank you for answering all my difficult questions. I appreciate you. Have a great rest of your day. Bye-bye.
Yes, bye-bye.